All right, let's get right into it. Today, we're tackling a massive puzzle that's got the financial markets completely rattled. It's a story that's all about contradictions, about computer algorithms, and this huge growing gap between what Wall Street is trading and what the world's biggest powers are secretly hoarding. Okay, so just think about it for a second. We've got a war raging. We've got inflation that just refuses to go away. By all accounts, everything happening right now should be sending the price of gold through the roof. It's the classic safe haven asset, right? And yet, we're seeing the exact opposite. The price is absolutely plummeting. So what on earth is going on?
Well, to really get to the bottom of this, we first have to look at the story you're probably hearing everywhere. On the news, all over the headlines. It's a very simple, very straightforward narrative.
And the message they're pushing is crystal clear. It's being blasted from every rooftop. The Great Gold Rally? Oh, that's dead. It's over. It's a narrative that's really designed to create a sense of urgency, maybe even a little panic, telling investors they need to sell and sell now, before the price drops even further.
So let's just walk through their logic here, step by step. It kind of goes like this. First, you get some hot inflation data, like the recent Producer Price Index. That, in turn, forces the Federal Reserve to say, whoa, we've got to keep interest rates higher for longer to fight this. Then, of course, those higher rates make the US dollar super strong. And the final step? Well, they argue that a stronger dollar makes an asset like gold, which doesn't pay you any interest, look way less attractive. It's a clean, simple story. A leads to B, leads to C. Seems to connect all the dots, right?
But what if that neat little story isn't the real story? What if something much more, mechanical is driving this crash? Let's move on and look at a completely different picture, one that the mainstream media just isn't talking about.
To really wrap your head around this alternative view, you have to understand a key player, the systematic hedge fund. Now, forget everything you think you know about traders yelling on a stock exchange floor. These are giant funds run by powerful algorithms. They make trades automatically based on rules that are pre-programmed into the system. It's all about momentum and volatility. There's no human emotion. Just cold, hard code making decisions in milliseconds.
Okay, now check out this alternative chain of events. It didn't start with some inflation report. No, it started when a conflict sent oil prices spiking. That spike absolutely terrified the bond market, and it pushed yields up. Now, the instant those yields hit a certain preset level, the algorithms at these systematic funds triggered. Boom! They automatically dumped tens of thousands of paper gold contracts onto the market in seconds. That first massive drop then forced all the smaller retail investors who were using leverage into margin calls, and that just created this self-feeding downward spiral. So here's the really crucial point from this perspective. This might not just be some random market panic. A cynical observer, as our source here puts it, might argue that this is a deliberate liquidity flush. The goal? Crash the paper price, shake out all the smaller, over-leveraged investors, and then swoop in and buy the real, underlying asset for cheap.
And here's the thing. This isn't a new playbook. Not at all. We saw this exact same pattern play out during the 2008 financial crisis. As the crisis really kicked off, gold took a massive nosedive, like 30 to 35%, as big institutions were desperately selling off paper assets to get cash. They flushed the market. But then what happened? As soon as all the weak hands were shaken out, gold started a historic 3-year rally to record highs. The mechanics at play today look strikingly similar.
So that's all the chaos happening in the world of paper contracts and algorithms. But while that violent reset is going on, the market for actual physical gold bars, the kind you can hold in your hand, is telling a completely, and I mean completely different story.
And this, right here, is the heart of the paradox. You've essentially got two separate gold markets moving in totally opposite directions. You've got the paper market, which is dominated by algorithms and short-term leverage, and it's crashing. But then you have the physical market, which is driven by long-term safe haven demand from huge players like central banks, and it's seeing record-breaking demand. Two markets, one asset, two totally different stories.
And just how much demand are we talking about here? We'll try this on for size. A staggering 863 tons. That's how much physical gold central banks bought last year alone. And get this, they're on track to buy another 800 to 1,000 tons this year.
And look, this isn't just some routine portfolio adjustment. We're talking about countries like China, Poland, and Uzbekistan strategically hoarding the real metal. They see it as a hedge, as protection against a potential U.S. debt crisis. You could even call it a de-dollarization play.
And from where they're sitting, they are more than happy to let Wall Street's paper games push the price down because it just lets them buy the real, physical asset at a huge discount. And you can see the real-world consequence of all this physical buying right here on this chart. This shows the registered gold inventory at the COMEX exchange. That's the actual physical metal that's available for delivery. Just last April, it was at a record peak. And today, that inventory has absolutely plummeted. I mean, look at that number. A 31% collapse in the deliverable physical supply in less than a year. The actual metal is being pulled out of the Western banking system at a rate we have never seen before. So, how in the world do we reconcile these two realities? You've got a crashing paper price on one hand and soaring, record-breaking demand for the physical asset on the other. What does this all mean for understanding its real value?
So, what are the crucial takeaways from all this? Well, first, it really seems like what we're watching is a mechanical reset of a very overcrowded, highly leveraged trade, not some fundamental verdict on gold's long-term value. The paper price has become totally disconnected from the surging demand for the physical metal. It's a huge warning about the trap of using leverage, and it shows us that central banks are using this very price drop as a strategic buying opportunity. So, at the end of the day, the bottom line is this. The real story isn't the daily price flicker you see on your screen. It's this widening, massive gap between the price of paper gold contracts and the finite physical supply of the actual asset that's being quietly snapped up by global powers. And that leaves us with one final big question to think about. In a world that is just increasingly dominated by digital and paper assets, what is the true measure of real value? Thanks for joining us.